Housing markets have had their best winter since 2007, according to figures released this week by RP Data. The company says prices for capital city dwellings rose 4.2% over the 3 months to the end of August.
Well, the increase has been led by housing markets in Sydney and Melbourne, and it's prompted a warning from the Reserve Bank Governor Glenn Stevens that there could be a correction. Well, joining us to discuss is property investment analyst and director of Empower Wealth, Ben Kingsley from Melbourne. Ben, good to speak to you this morning.
Thanks for having me on.
Let me ask you straight out, are we in a bubble, particularly in those markets of Melbourne and Sydney?
Look, Andrew, I don't think we're in a bubble. To be in a bubble, you really need to have speculative buying, and I don't think we're seeing speculative buying in the current marketplace. In relative terms, there's no doubt that affordability at the lower end of the market is something of a concern, but where we're seeing the activity at the moment in those capital cities is in the inner city areas and the rings around that middle city range. And when you combine double household incomes in those particular areas, those properties that are selling and the price growth we're seeing in those areas are reflective of the income. So we're not seeing any pressure there. What we are seeing is certainly no first home buyers in that outer rim, where we're seeing that sort of new estate markets and the house and land packages. We're not seeing that sort of spontaneous buying out there or land appreciation happening crazily out in those outer suburbs. So I think where we are is reasonably balanced. I certainly wouldn't want to see another 10 or 15% growth in these city locations over the course of the next 12 months. I think that might be a bit heavy, but overall I'm quite comfortable where the market's at the moment.
Ben, potentially not a bubble, but do you see a fall coming? Is there a correction looming?
Not yet, no. I think, look, when any time you see a cycle where we've got capital growth occurring, and we've seen some big ones, you know, in 2001 to 2003, we saw across Australia around a 40% growth cycle, and that was a very, very large cycle. And then we saw some tapering off of that. In the last cycle we had in the sort of 2009, 2010, we saw property prices come off around 5 to 8%. This time around, we're up around 10 to 15%. And in the major cities, Melbourne and Sydney, we're probably up around 15 to 20%. So there's definitely, I think, a bit more to be had in this particular growth phase. And we'll probably see some areas come off around that 5% once interest rates start to rise, which might be sort of around the sort of middle of next year.
When you say there's more to come in that growth phase, is that then being driven by investors? They're the ones with the money. They see that there are more gains to be made.
Andrew, it's a really good question. I think from that point of view, we need to understand in this particular growth phase, we're seeing more investors come into the market, having more confidence around bricks and mortar. So there is a little bit of a concern in that respect, but generally speaking, you know, at the end of the day, 70% of the marketplace is controlled by owner-occupiers, and they're looking to get into the market and into the suburbs that, you know, that give them the lifestyle drivers and the things they're looking for, and they'll pay a premium to get into those particular markets. So there is still got to be competition for values to grow higher, and there's got to be a shortage of supply. So we definitely have a shortage of supply. We've got growing populations into our major cities. So I think from that point of view, I wouldn't see a correction being too dangerous, and I'm certainly not thinking it's overcooked at any stretch of the imagination at the moment. I think the spring and summer selling seasons will still see some consistent growth, and then we'll sort of look at the new year and then see what happens with interest rates.
So on that point, on interest rates, where do you see it going?
Yeah, look, in terms of interest rates, look, the Governor, Glenn Stevens, has made it very, very clear that he's not going to put rates down any further unless there's some type of global collapse, and he needs to put money stimulus into the marketplace again. So from that point of view, we're going to see no more rate cuts at all, is my opinion. And then when we actually look at the new year, I think inflation's going to be a concern for the Governor and the board, and I think we're going to see rates sort of moving higher probably in the second half of 2015.
All right, so, well, I mean, you talk about a correction, though. What sort of number are you talking? Well, obviously, it's not enough to alarm punters out there, I would have thought, because you would have been more alarmist, I'm sure. But how far do you think it might fall if there is a correction?
Yeah, I think what we need to understand is there's a lot of markets within markets when we talk about the property market in Australia. I mean, there's 15,000 suburbs. So in relative terms, you're going to see some of the areas where affordability has been stretched. So my concern would be in areas where, you know, sort of house and land packages are selling in that sort of $600,000-700,000 range and being sort of 30 kilometres from a major employment centre. And in terms of affordability for that household where maybe, you know, the sort of repayments on their mortgages is about 30% of their gross income or 35% of their gross income. When I start to see those sort of numbers, I suspect that when the economic conditions start to deteriorate and, you know, it puts pressure on jobs and unemployment levels there, that's where you potentially get a supply of people who have to sell out. And when they have to sell out, that's when we start to see a correction in those particular markets. So I'd be more careful when I'm buying out in the new greenfield areas and the new estates, but the inner city areas and the middle ring areas and areas where the sort of land has been fully utilised, we don't sort of see the same types of corrections occurring. And then the other market where we see some correction occurring is really in that top end of the market, so that absolute elite end in that sort of $2 to $5 million price range. You know, when times are good, values tend to go very high, but there's a little bit more volatility in those particular markets. But on the whole, I wouldn't have seen, you know, if we have another 5 or 10% price growth over 12 months, I suspect we might give up maybe 3 to 5% of that, you know, in the whole.
Ben, very quickly, are you seeing evidence that people on lower incomes are being stretched with their mortgages at the moment, particularly those who have taken out low doc loans?
Look, the low doc loan environment is certainly a lot more subdued than what it was pre-GFC time. So I'm not concerned about that. I think the banks are doing a fairly reasonable job in their assessment rates. You know, they're factoring in rates going back up when they're doing their borrowing assessments for their clients. So I'm not too worried about that. I am saying to anyone who's looking to get into market, and certainly first home buyers as well, is to make sure that you factor in not only what you can afford today, but also put, you know, maybe 1 or 1.5% increases on what you're currently paying on your mortgage. And then secondly, start to think about what's going to happen in your household that changes. So if you're looking to start a family or there's going to be a decrease in incomes, you've got to be able to make sure you can manage through that period. So don't jump into the market until you really do know that you've done your sums and you can actually afford to stay in the market for the long term, because property prices and getting into property is an expensive exercise and it can be costly. So you just got to make sure you've got the household cash flows to afford to get into the market.
Good advice. Property analyst Ben Kingsley, thank you very much for your time.
Pleasure.